got color in your cheeks?
Okay, we're going to wrap up the valuation videos with this one, and we'll start by taking a look at the free cash flow approach to valuation. And this is basically just a simple extension of the dividend discount model. We're just going to replace the dividends paid with the free cash flow from a firm. And we're going to replace the discount rate for a stock, the R sub S, with the weighted average cost of capital for a firm, and we'll denote that with WACC. So you can see these things line up really well. The price today, this is for the firm valuation model. Dividends, all discounted at the appropriate rate, the appropriate number of periods, and we end up with this, the formula we've already looked at several times. If we extend that to the value of a firm, what we're going to get is the value today, V sub 0, is going to be equal to the present value of all the future free cash flows of the firm. And we'll define free cash flow here in a minute. But if we take the free cash flow for period 1 and discount that by the weighted average cost of capital for one period, so that means we're going to divide it by 1 plus WACC raised to the first power. And then we take the free cash flow for the second period, the free cash flow for the third period, etc. Discount all those free cash flows back, we're going to end up with the value of the firm. So we can modify the model that we had, the constant growth model, and come up with a formula for the enterprise value of a firm. I've denoted that here with the enterprise value at any time period t is going to be equal to the free cash flow for the next period divided by the WACC minus the growth rate if those free cash flows are growing at a constant rate. All right, so we have to have that assumption again. And also there's another important one, that the WACC is greater than the growth rate. So if those two things are true, if the free cash flow is growing at a constant rate and the weighted average cost of capital is greater than the growth rate, we can transform that dividend growth model into a company valuation model using free cash flow. So free cash flow is defined as the cash available for distribution to investors, and that would be both stockholders and bondholders or debt holders. And it's equal to NOPAT, so the net operating profit after taxes. And then we're going to subtract from that number the net investment in new operating assets. So another way of saying that the new invested capital in the firm. So it's going to be two pieces. It'll be the investment in working capital and the investment in long-term assets. So we're going to look at an example of valuation using free cash flow. And we're going to start with, let me make this a little bit bigger, a simple balance sheet up here at the top. I've got on the left-hand side the assets, the current assets up at the top, the fixed assets towards the bottom. We've got total assets of $7,400 in year 1, $8,000 in year 2, so the firm's assets are growing. They're making investments in the firm. And then on the right-hand side, we've got the liabilities. The current liabilities up at the top, the long-term liabilities at the bottom, along with the equity. And what we want to do is take that and then use this income statement and build the free cash flow for the firm. So with our income statement, we start with sales. We subtract out the cost of goods sold to get the gross profit. We take out the selling, general, and administrative expenses, kind of the fixed expenses of the firm. We come up with EBITDA, earnings before interest, taxes, depreciation, and amortization. We have a depreciation expense of $200. We end up with EBIT, $1,450. Take away interest. So that interest is the amount charged on our long-term and short-term debt together. We come up with the taxable income, earnings before taxes here. Our tax rate is 40%. That's the assumption here. And once we back out the taxes, we're left with net income of $690. So that would be the bottom line. But what we're concerned with to come up with free cash flow is to look at NOPAT, which is equal to EBIT times 1 minus the tax rate. So let's move down in our spreadsheet a little bit and come up with the free cash flow calculation. So the NOPAT is going to be equal to the EBIT times 1 minus the tax rate. The tax rate, by the way, is given down a little bit further. You can see here the tax rate assumption is given. But if we multiply EBIT times 1 minus the tax rate, that's going to give us $870 of NOPAT. And from NOPAT, we want to subtract out the investment that the firm has made in working capital and net property, plant, and equipment. So the working capital changes, let's look up at the spreadsheet to see what's going on there. I'm looking at the changes in the current assets and the current liabilities. And by the way, it's the operating current liabilities, not any financial current liabilities. So that's why I'm excluding the short-term debt. So if we look at the current liabilities, they increased by 400. My current liabilities, the operating ones, increased by 200. So I have a net increase of 200. Okay, that's the increase in my working capital. And that required an investment on behalf of the firm. So that's why I'm subtracting out that difference in the operating working capital. So it took $200 to inject into the firm to build up our working capital. Also, we had an increase in PP&E of $200, and that's the net PP&E. I just linked it to this side here. It's after we've taken into account the depreciation. So in this case, we've invested a net of $200 into the firm. And actually, I want to break this up a little bit differently and see what we end up with. We'll end up in the same place. I just want to show it a little bit more explicitly what's happening. Okay, so over here I've shown an alternative calculation for the free cash flow to the firm, and we end up with the exact same amount of $470. But I want to talk through this real quick. The NOPAT is as it was before, EBIT times 1 minus the tax rate, so it's still $870. Now we're going to add in depreciation. And so the depreciation is given in our simple income statement. And the reason I'm adding it is because it is a non-cash expense. So it's been taken out before EBIT, it's been taken out prior to EBIT. So I want to add it back in because it represents cash that's available to the firm. And now I'm going to take away the net operating working capital as we did before. And finally, the last change would be to take away the gross property, plant, and equipment change. So instead of the net one that I did a minute ago, I'm going to use the gross change. And if I go up here and look at the gross property, plant, and equipment, the difference, that $400 is saying that the firm wrote checks for $400 to buy property, plant, and equipment. So I kind of like this way of outlining things because it explicitly shows the investment that you made in net operating working capital. So you wrote checks for $200, and you wrote checks for $400 to buy property, plant, and equipment. Either way that you come up with the calculation, the important thing is that they're the same, and the free cash flow is what we're going to use to value the firm. So I've got free cash flow of $470 in year one. That's going to be the end of year cash flow for the first year. Now, if I do some things similar to what I did with the dividends and assume that the free cash flow is going to grow by 12%, then 10%, 7%, and 5% thereafter, so it's going to finally hit a constant growth rate of 5%, I can value the firm in the same way that I valued stock before. So let's just look at this. I'm sorry, I've come up with free cash flow at time period 0. This is prior to the analysis. Now, free cash flow for time period 1 is going to be 12% bigger. So I've just grown the $470 by 12%. Then I grow that number by 10%, the next number by 7%, and then finally I grow it by the constant growth rate of 5%. Notice I'm getting here a calculation for the terminal value of the firm. This is analogous to finding the stock price at the end of the supernormal or the non-normal growth stage. So in this case, I'm just going to divide the year 4 free cash flow by WACC minus the growth rate. So if you look here, I've got the year 4 free cash flow of $650. I'm dividing it by WACC, which is 9%, taking away the constant growth rate of 5%. So I'm dividing it by 0.04. I end up with a terminal value of the firm of $16,263. That number, by the way, is the present value of all future cash flows for the firm, all future free cash flows from the firm. So year 4 to forever is represented by this number, this terminal value. So if I kind of do the same process that I did with the stocks and find the present value today of those free cash flows that the firm would receive, I've got 482, 487, and then the present value of the terminal value and that third free cash flow is $13,000. Add them all up, I've got $14,000. All right, now let's move down to the kind of the final calculation here. The present value of all my future free cash flows is that number we just calculated, 14,000. If I add back in the marketable securities for the firm, so if we go back up to the balance sheet, I've got marketable securities of 400. Then my enterprise value is 14,407. I subtract out the book value of the debt, and again, we can go up here to the balance sheet. That's going to be the short-term debt and the long-term debt. Add those up, and that's the book value of my debt. We're going to assume that the market value and the book value are the same. So if I subtract out 3,100, I'm left with the equity value of the firm. That's going to be 11,307. If I divide that then by the number of shares I've got outstanding, then I come up with an estimate of the value of a share of stock. So in this case, $56.54 should be the value of each share of equity based on this free cash flow approach. And we're going to do some examples of this in class. This is to give you a taste of that, and we'll pick it up with a little bit more detail and a little bit more explanation in our class time together. So in wrapping up the video here, I want to look at these last couple of slides. Well, actually, we did this. We've done this slide. We found out what the enterprise value was. We subtracted out the debt to get an estimate of the market value of the equity or the stock. We divided it by the number of shares, and we got a value of the price per share. So we've done this. Last thing I want to talk about are relative valuation models. So this is different from the cash flow valuation models that we've talked about to this point. With relative valuation models or market multiples, what we're doing is looking at comparable firms, comparable transactions, and trying to make gain some insight from looking at what's going on with similar firms in similar industries across the market. With the market multiples, we might be looking at the price to earnings ratio, the PE ratio, or the price to book ratio, or even the price to sales ratio, to get some sense of what our firm would be worth based on looking at other firms in the market. So a couple of keys here. We want to compare to similar companies and similar industries. We don't want to compare apples to oranges. This goes back to some things we've talked about before with ratio analysis. We can only make sense in comparing numbers for firms that are very similar, that are operating in the same industries, doing the same kinds of things. Another thing to keep in mind here is that we want to compare using representative numbers. And so that means we might want to adjust for extraordinary items, for extraordinary things that happen in any particular year, using these multiples. So for instance, if there's a really large extraordinary gain that happened, for instance, a firm sold a big chunk of assets and they have this special one-time gain, it would be bad to use those numbers in the multiples calculation because it's a one-time event. It's not representative of what's really going on with the firm. So we want to adjust for extraordinary things whenever we're using this multiples approach. And then finally, the cash flow multiples. Here we're going to look at valuation using cash flow. We just talked about EBITDA and enterprise value. We can use multiples looking at other firms and how they've transacted in the market by looking at asset multiples and getting some sense of the relationship between the value of the firm and the cash flow that the firm is producing. So this has some advantages over market multiples. It takes away some of the distortions that might happen with earnings. It takes into account the capital structure and the tax structure and other decisions that the firm makes and makes comparisons a little bit cleaner. Again, we're going to look at the relative valuation models in more detail in our class time together. This just gives you an overview of what we'll be doing during that time. So we'll stop here. This is the end of the videos for valuation, and we'll add more detail in class.